Hi folks, and welcome back to Meaningful Money. Okay, I'm here now in Penberth Cove. It's just about the only sheltered place I've found to film today, because it's a really windy day. But we need to carry on talking now about taxation as far as trusts and trustees are concerned. We talked about income tax last time, and this time it's the turn of capital gains tax. Now you'll be pleased to know that capital gains tax, or CGT, is an awful lot simpler than income tax. It's basically a flat rate tax of 28%. Thanks very much for watching, and no, obviously it's not quite that simple, but not much more complicated than that. When we talked about capital gains tax from a personal and individual point of view, you remember that every individual has an annual allowance that they can gain in each year before they pay any capital gains tax at all. Now that's the same for trusts, but it's half of what an individual gets. Individual gets $10,100, a trust gets £5,050. And all that means is that if trustees sell an asset, either some shares or a property or whatever, and they make a gain on that sale, then the first £5,050 will be tax-free, but every pound of gain above that will be taxed at 28%. Now that rate of 28% is quite new. It went up to that in June 2010. Prior to that it was 18%. Now, excuse me, when a settler gives a property into trust, that is a disposal for capital gains tax purposes, and ordinarily the settler himself or herself could have to pay capital gains tax, because that gift is deemed to be passed on to somebody else, and whatever the value of that is at that point, any gain that the settler has made, they would have to pay tax on. But there's a relief called holdover relief, which in this case applies where a transaction would ordinarily be deemed a gift and therefore possibly attract inheritance tax. That's my notes falling down, so I'll just hold them. Where a transaction would normally be deemed a gift and therefore could potentially attract inheritance tax, the revenue sees fit to give relief called holdover relief. Now, I don't want to complicate things because we're talking about capital gains tax today, but all it simply means is that if a settler would ordinarily make a gain and therefore have to pay capital gains tax when he gives something to a trust, the holdover relief means simply that the gain or the tax on the gain can be deferred. And so what happens is the trustees, who now own the asset, take on the sort of latent gain in the property. So let's say I bought a property for $100,000, and when I give it into trust it's worth $200,000. Well, my gain is £100,000, and ordinarily I'd have to pay tax on most of that. But what happens is when I give the property to the trustees, it's like they gained it at the original price of £100,000. And so now I'm not liable as the settler anymore, but the trustees, if they subsequently sell that property, take on all the latent gain that they took on from me. Now, if the trustees pass that property eventually to the beneficiaries, that same relief can apply. So the beneficiary now can take on the gain of the trustees, which in turn was the gain of me, the settler. So I was just sort of passing the gain along, and then it's when the beneficiary sells that they could pay capital gains tax at that point. So that holdover relief is pretty useful relief, because it means that capital gains tax really isn't an issue when making a gift into a trust or when passing the property of the trust to the eventual beneficiaries. Now, when it comes to interest in possession trusts, there's just couple of little wrinkles here. Interest in possession trusts, remember, have a life tenant, somebody who can benefit from the income of the trust while they're alive. Well, for interest in possession trusts, which were set up prior to the 22nd of March 2006, what happened then was that if the life tenant died, because with interest in possession trusts, the property, the value of the property is deemed to be in the life tenant's estate, When they died, the gain to that point was kind of wiped out, and it was a new sort of clock started ticking at that point. And so the eventual beneficiaries, if they subsequently sold the property, their gain would only start from the point at which the life tenant died. Now that does not apply, I'm afraid, for new interest in possession trusts. Got to be careful with those. Now finally, we need to talk about bare trusts. Now bare trusts, remember we talked about them last time, because they're effectively transparent, they're straight through trusts, they're ignored, largely speaking, as far as capital gains are concerned. Now any gain which is realised, because the bare trust, effectively the gain is realised by the beneficiary, that the amount of the gain is added to the beneficiary's income in that year. Now if that gain added to the beneficiary's income keeps the beneficiary within the basic rate tax band, they will just pay 18% on the gain. But if it takes them into the higher rate band, they will pay 28% on whichever amount of gain is within that band. So those are just a couple of little extra wrinkles. I think I've dealt with them all. I don't like to look at my notes, but they fell off the rock in front of me where you couldn't see them before. So never mind, so that's capital gains tax. We've got one more tax to deal with, and that's inheritance tax from a trustee's point of view. So that's next time. So for now from Penberth, thanks very much for watching, and I'll see you next time.